Hey there, today we're going to share 3 cool ways to use the moving average indicator. It's a handy tool that helps you know when to buy or sell. What is a moving average? Let's talk about moving averages. They are useful tools that helps you figure out the average price of an asset over time. It's like taking a bunch of numbers and finding their average, but with price instead. For example, if you look at 20 days of prices, a moving average would give you the average price of those 20 days. This helps us understand what's happening with the price without getting overwhelmed by all the ups and downs. There are different types of moving averages, and each one is good for understanding different kinds of trends. Moving averages are handy for figuring out trends in the market. You can use different ones for short-term or long-term trends. Some popular ones are 20, 50, 100, and 200. Basically, moving averages make it simpler to see what's happening with prices. So, you can decide whether to buy, sell, or hold on to something. But there are some specific ways to use them that can help us make better trading decisions. Let's explore those together. But before that, hold on to your seats because I'm about to introduce you to a game-changing tool, the FastBull Economic Calendar. FastBull brings you up-to-the-minute updates on economic events, keeping you one step ahead of the market with accurate and timely information. Whether you are a trading pro or a newbie, their economic calendar is a must-have resource for making smart trading decisions. One of the coolest features of the FastBull's economic calendar is the ability to filter economic events by time. You can quickly view events happening today, tomorrow, this week, or next week. You can even set your own custom date and time range. It's all about what works for you. The calendar gives you all the important details you need, like the event's time, impact, which is shown by stars, indicators, actual value, forecast, and predictions. Plus, you can dive deeper into each event by clicking on the view option for detailed historical data and insight. And the cherry on top, you can set alerts for events you're most interested in, so you never miss a bet. And don't forget to check out their trading competition where the top 10 participants with the highest profits can win cash awards ranging from $100 to $10,000. To access the economic calendar and more amazing tools on the FastBull platform, just check out the links in the video description below. Seriously, this tool is a trading game changer. Don't trade without it. Now let's get back to our main topic, uses of a moving average. Moving averages are great for 3 main things. First, spotting trends. They help us see if the prices are generally going up, down, or staying the same. And the second one, catching trend changes. When a moving average changes direction, it can signal that the trend might be changing too. And the third one, finding support and resistance. Moving averages can show us levels where prices might have a harder time going past or where they might bounce back from. So first, let's learn how to spot trends with moving averages. We've got 3 ways to do that. The first one is price versus moving averages. When the price consistently stays above the moving average, we can identify an uptrend. This means that the overall market sentiment is bullish and buyers are in control. As a trader, you would want to focus on finding opportunities to buy and ride the upward momentum. Conversely, when the price remains below the moving average, we can identify a downtrend. This suggests that the market sentiment is bearish and sellers are in control. In this case, you should look for selling opportunities, aiming to capitalize on the downward momentum. And the third one is price fluctuating around moving average. If the price frequently crosses above and below moving average, it may indicate a sideways or range-bound market. This means that neither buyers nor sellers have a firm grip on the market, resulting in price fluctuation without a clear direction. In such situations, it's best to wait for a clear trend to emerge before making any trade. Now, let's keep it up a notch with a cool trick for better analysis, using 2 moving averages with different time settings. This way, you can see both short-term and longer-term trends in the market. Check out this chart example. We've got a 20 MA line and a 200 MA line. The 20 MA shows a short-term trends, while the 200 MA gives us the long-term picture, focusing on just 20 MA. we can spot uptrends when the price stays above it and downtrends when it's below. But if we only look at the 20 MA during this period, we might have missed the bigger picture. Now, let's bring back the 200 MA. Notice how the price stays above it the whole time. This tells us that the market was actually in a long-term uptrend. So selling during those short-term downtrends could have been risky since it would have gone against the overall trend. Using two moving averages help us make more informed trading decisions by giving a broader perspective on market trends. Let's check out another example. When we zoom in on this chart section, the price dances around the 20 MA, telling us there's a short-term sideways trend. But look closely, the price stays above the 200 MA, which means we've got a long-term trend. So we've got a mix of sideways trends and a long-term upward bias. Using two moving averages won't necessarily give you better trades, but it's definitely help you dodge those not so great ones. When we talk about the slope of moving average line, we're looking at how it's angled. Is it pointing sharply up or down, or it's more like a gradual slope? In a strong uptrend, the moving average line will be angled steeply upward, close to 45-degree angle. This means that the line is pointing almost straight up, which tells us the upward trend is really powerful. On the flip side, during a strong downtrend, the moving average line will be angled sharply downward, again close to 45-degree angle. In this case, the line is pointing almost straight down, showing us the downward trend is super strong. Let's talk about using two moving averages to spot trends. Well, use a 50 moving average, a smaller, and 200 moving average, which is larger in this example. When the 50 moving average line is above 200 moving average line, it's like they're saying, hey, the trend is your friend and it's going up. This means we're in an uptrend, so keep your eyes peeled for a good times to buy. On the other hand, if the 50 moving average line is below the 200 moving average line, it's like they're telling us, hold up, the trend is going down. This is a downtrend, which means you might want to look for opportunities to sell. Basically, we've got two moving averages helping us spot trends and figure out if you should be buying or selling. Alright, let's talk about how moving averages can help us spot trend reversal. When the market might be changing direction, we've got two tricks up our sleeves for this. First, price crossover. Remember how we said the price usually stays above the moving average in an uptrend and below it in a downtrend? Well, if the price crosses the moving average line from above, it's like warning light telling us the uptrend might be over and a downtrend could be coming. That's a bearish reversal signal. On the flip side, if the price crosses the moving average line from below, it's hinting that the downtrend might be done and new uptrend might be starting. But be careful, not every crossover is a surefire signal, so don't jump the gun. The second one, moving average crossover. Another trick is to watch when a short-term moving average line crosses a long-term one. If the short-term line goes up through the long-term line, it could mean a possible uptrend is coming. And if it goes down through the long-term line, it could signal a possible downtrend. It's like having two friends giving you a heads up about potential trend changes. Alright, now let's dig into how moving averages can help us spot those ever-changing support and resistance levels. Usually support and resistance are like price zones where we expect the market to become back. But with moving averages, we get dynamic levels that keep up with the trend. Pretty cool, huh? In an uptrend, the price tends to hang out above the moving average line. When it comes back down to say hello, it often finds support, like a trusty friend. This means we might find sweet buying opportunity near the moving average when the trend is our friend. Now in a downtrend, things flip. The price usually stays below the moving average, and when it tries to climb back up, it finds resistance. Imagine it like a pesky rival that keeps pushing it back down. In this case, we might find chances to sell when the price is near the moving average. And there you have it, moving averages as dynamic support and resistance. Who knew one little line could do so much for us traders, right? That's a wrap up on our moving average masterclass. I hope you enjoyed learning all about this handy indicator. If you're hungry for more trading knowledge, why not check out our YouTube TradeGenius channel? And if you like this video, hit that like button and subscribe to our channel and stay tuned for more awesome trading content. Until next time, happy trading, my friends.